This series is all about getting started in property because that's a very popular topic, and in the first video I am going to cover whether you should buy and hold or buy and sell. Alongside that, I'm going to cover whether you should have the business in your own name as a sole trader or have it in a limited company. So watch out for all the fantastic tips. This series is all about getting started in property. Now, property is very popular, especially for people who are either perhaps looking to stop full-time employment or looking for an additional source of income or looking to create multiple streams of property income or business income, and then therefore they think, what do I do? Property seems to be a well-tried, tested, trusted source of income, and it's going to be my absolute pleasure to share with you everything that I know through these different episodes to help you get on the property ladder. And if you're already on the property ladder, there'll always be one or two golden nuggets which you can use to accelerate your property business. So the most important question, I guess, is should you look at buy-to-let or should you look at selling? Before I go into those, what I want to say is there are lots of different property strategies. There's not just two in terms of do I buy and hold or do I buy, refurbish and sell. There are other strategies, and I will cover those on a different episode, but for now we'll keep it really simple, especially for people who are just starting off. Do you buy and hold or do you buy, refurbish and sell? So generally speaking, buy and hold is known as buy to let. It's a long-term strategy, and people tend to build their portfolios at a particular pace and then rent it out to tenants. The good thing is it's relatively low risk. It's a well-known, well-trodden marketplace. So you'll find lots of information on it, you'll know lots of people who've done it before, and you've got, it's asset backed, so you have real estate, bricks and mortar, so the risk is pretty low generally speaking. Another advantage is it gives you regular cash flow. Now this is important because a lot of people starting off tend to, for some reason, think about capital appreciation. So they think, I'll buy a property, rent it out, it covers my mortgage, usually interest only, so it covers my mortgage. Now in 10 years time or 15 years time, the property will increase, let's say by 50%. Let's not worry about the exact number, let's just call it 50%. It'll increase by 50%, so therefore I'd have made a gain. I think that's the wrong way to see it. You should buy property and look at regular cash flow, so monthly cash flow coming in, plus the capital appreciation you should see as an extra advantage stroke Brucey bonus in my world. And if you know Bruce Forsyth, you'll know what I mean by Brucey bonus. So regular cash flow is important, very important. Some of the things you need to be aware of is that you're going to have tenants, which sounds obvious, but you're going to have tenants and you're going to have maintenance costs, whether you look after them yourself, whether you outsource them, whether you give them to a letting agent. They're going to crop up regularly, and the more properties you have, the more issues you're going to have, so make sure you're comfortable with that. There'll be ongoing costs that you'll have to pay in terms of council tax and insurance and wear and tear on the property, which links in with maintenance costs, so make sure you factor those into your calculations when you're looking at whether a property works for you or not. You then obviously have to file tax returns and your accounts with HMRC, and I'm going to come on to that a bit later on when I talk about whether you should have the property in your name or in a limited company. And usually it's slow to make a lot of money. Now of course you can look at HMOs, you can look at rent to rent and some of the other strategies like service accommodation, which I will cover in a different video, but generally the simple buy-to-lets, if you've got one property, you're not going to make that much money. But as you scale up, and depending how quickly you scale up, you can very quickly replace your salary from a full-time job. I've known people who've done it within 12 months. Some might take 3 years, some might take 5 years, some might never do it. It all depends on how you want to, how quickly you want to grow your business. The other option is obviously to buy and sell. Generally speaking, this is a short-term strategy, although some people do go on to become property traders and developers. And buying and developing properties to sell at a higher rate can be slightly risky because you don't know how much value you're going to add. Once you've been at it for a while, you'll then be experienced, you'll know exactly what you're looking for, you'll start looking at buying properties below market value and then adding value to them and then selling them. Sometimes you might even look at extending sideways in the back, going up in terms of another floor, depending on the type and size of property. It's harder to do with just a small house, easier to do with commercial property, which I will cover on a different episode. So the main advantage I see is you can make a lot of money very, very quickly. So you buy a house for £100,000, it's below market value, it's worth £120,000. Let's say it also needs some work doing, you spend another £20,000 on it. So you bought it for 100 grand, you spent 20 grand on it, it's costing you 120, legals, all that type of stuff. Let's say it's another £5,000, it's £125,000, and let's say now the property is worth £175,000. If you wanted a quick sale, for example, you could sell it for 160, even 150, make money very quickly. How much you sell it for and how quickly you want to sell it is a different question. The point I'm making is you can add value and sell it pretty quickly because it's a well-known marketplace. A lot of houses are bought and sold every single day, every single week, every single month. And you don't have to do any ongoing maintenance, and you don't have to worry about ongoing tenants and voids and all of the other challenges that come with renting a property. So that's good. Disadvantages are no regular income. So it does usually, especially those who aren't experienced, it takes them longer to refurbish, redevelop a property than they thought. So the internal rate of return is much lower than they thought. So they might think they're going to make, let's say, £20,000 in 12 months, but they end up taking 24 months. So they take 2 years and still make the same amount of money. So now, even though your fixed return's the same, it took you 2 years, so it took you a lot longer to get the money back. So that's something you need to be mindful of. Also, development is more sensitive to market conditions, generally speaking, and when house prices drop, you're going to feel the pinch a lot. So bear that in mind when you're doing your calculations. And another thing to be aware of is you're going to have to deal with contractors and builders. Not everybody likes that experience, so make sure you have a good power team around you of people who can help you. Generally speaking, there would be a deal sourcer, agents, a good accountant and a property tax advisor, a good lawyer or conveyancer, an architect, planning consultant, building contractor, and somebody in your team who can work with you in your office as an admin assistant to help and support you, and a PA. Again, depending on the size of your business, the bigger it is, the more of these people that you'll need on a regular basis. So those are the real basics that I've covered. I mean, we can go in depth here, but this video is just about covering the basics to raise your awareness. So if you like the content so far, click like, press subscribe, post a comment, let me know what you think of the comment. Let me know if you want me to go deeper in any one of the areas I've just covered, or if there's anything else in property that you want me to talk about in terms of buy-to-let versus trading or development or commercial conversions or buying land with planning and building houses. That's the kind of area which I operate in. Now, should you buy the properties in your name or should you buy them in a limited company? Well, if you buy them in your own name, you've then got Section 24 to deal with. In a nutshell, Section 24 is basically you cannot claim all of your mortgage or finance costs. So if you become a high rate taxpayer or your rental income pushes you into the higher rate of tax, you only get a 20% tax credit. Whereas if that weren't the case and you're a high rate taxpayer, you'd get 100% relief. So that's something you need to be aware of. And it is going to be quite costly. You had something called wear and tear relief, that's no longer available, so that's something you need to take into account. But if you're not into property already, then you won't know of that, so that's not going to be as crucial for you as it was for those who were in property a number of years ago. That's been replaced by the domestic replacement allowance, I think it's called. I always forget the name. So you can still claim for goods, but not the first time you buy them. So if you buy a fridge for a property, you can't claim it the first time around. Even when you sell it, you can't claim the cost of the fridge. When you replace the fridge, I think it's called replacement of domestic items. When you replace the fridge, you can then claim for the replacement. if you replace the fridge with the fridge and freezer, you can only claim the cost of the fridge and not the freezer. So you got to keep good records. The good thing about having property in your name is that it's flexible, and also you keep all the control, and there are lots of mortgage products available out there, and the interest rates are pretty low. The disadvantage is you've got unlimited liability, so you're responsible for everything. You're next on the line. You've got Section 24 to worry about, and that is going to be quite painful. And then you've got to pay income tax on your profits. That means if you have a job somewhere and you're working full time, your property income or profits will be added to it, and then you've got the added paying of Section 24. So you could end up paying a lot of income tax, even though you don't take any money out of your sole trader account for your property business. You leave it all in there because you want to reinvest it. Now your other option, apart from having a partnership or a limited liability partnership, your other obvious and main option is having a limited company. So the good thing about limited company is it's a separate legal entity, and the risk is ring fenced within the company and you aren't personally liable. Another benefit is you only pay corporation tax at the moment at 19%. So if you're looking to recycle all of those profits into buying more property or putting up more deposits, let's say you made £10,000 profit, you'd pay £1,900 in corporation tax, and £8,100 you can invest in the next property. It doesn't matter if you have a full-time job, as long as you don't take any money out of the company, you don't pay any tax. And the first £2,000 you take out anyhow are going to be tax-free if it's a dividend, as long as you don't have any dividends from elsewhere. So that works really well. Like I said, you can reinvest more of your profits. That works well. If you're looking to add other shareholders or directors, you can do that pretty easily. There would be tax consequences for adding other shareholders because there would be a capital gain if you sell some of your shares to them. So speak to a tax advisor and they'll tell you more about that. Then you've got the opportunity to add your children or other family members to the property business by way of having alphabet shares or growth shares. Again, talk to an accountant and they will be able to tell you more about that. The disadvantage is, of course, there's double taxation. So when you take the money out, you've paid corporation tax, then when you take the money out personally, you then have to pay income tax depending on the total salary plus dividends. If you're taking a dividend, if you don't have a job anywhere else, you've got your personal allowance and your £2,000 tax-free dividend. But if you have a job elsewhere and you've got dividends coming in from elsewhere as well, then any money you take out of your property business, you're going to have to pay further tax on it above and beyond the corporation tax. Another disadvantage is there's limited choice compared to having properties in your own name in terms of mortgages and lending products. So it's tighter. Now linked with that, the rates are higher. So the interest rates on buy-to-lets through a company are going to be higher than they are in your own name. So that, in a nutshell, is the very, very, very basics of thinking about the type of property business you should go into. Again, I've kept it very simple, as in should you buy and hold or should you buy, refurb and sell, and I've kept it very simple in terms of sole trader versus limited company. I could spend very easily 90 minutes talking about all of those topics, but that's going to make a very long video, and I'd rather share a bit of content with you, let you think about it, and then post some comments below, ask questions and continue the engagement. I hope and I think you're going to find that more useful than a 90-minute video. So watch out for the next episode. Until then, bye for now.